Three, two, one, live. I think I've got that down. All right. How you doing, friends? Ernie here, and this is the Zero-DTE podcast, episode number 61. And today's episode is entitled Zero-DTE is resilient to the Moronic COVID variant and market volatility. What is the I'm sorry. I got that wrong. It's not the Moronic COVID variant. It's the Omicron COVID variant. It's another take on Greek letters. They ran out of, I guess they went from alpha, beta, lambda, and now they're up to omega or Omicron. It never ceases. But there is a variant of the COVID virus that appeared coincidentally on a day that the market was half on, half off. Very low volatility, very low volume on Friday, right after Thanksgiving. And that's a day when anything substantial happens, you could easily, anybody with any kind of force can easily move the market up and down. And it did. It moved down significantly. On the news of a new variant, a multi-mutant and possibly vaccine-resistant strain that they have now dubbed Omicron. Or, if you take that as an anagram, Moronic. And yes, I said Moronic on purpose because that's exactly what it is. There was news that initially came out. Now, first of all, they've known about this particular strain for quite some time. I think since July. However, now that they chose that this was the time that they would bring it out because I guess there were a few people that have come down with it. And by all accounts, this particular variation, this variety, this variant, this mutation, multi-mutant, is quite harmless. Probably not much worse than the common cold. However, it is very transmissible. But it is the perfect thing to bring up, particularly with some of the things that might scare people, like multi-mutant, vaccine resistant, highly transmissible. All of these things are things that can bring up the ire in people and the fear. And of course, that is absolutely the point. There was really no reason to bring this up right now other than to move the market. Why did the market need to move? You've got to think, when things like this happen, when you know all the backstory, that the virus or the variant has already existed for quite some time, and then it waits for this particular time when the market is most vulnerable, easiest to move, it's obviously what we would call in the business a false flag. A doctor came out almost immediately saying that they've known about this for a while and it's really almost harmless. However, you have the news outlets that are trying to push this as something potentially fearful because that's basically how they get eyes on their site. They are more interested in creating a story than reporting a story. And in fact, often, not only will they embellish or add hyperbole to a story, but quite often they will literally make it up out of thin air. And for this reason, well, this is going to sound maybe political, but I believe that the press is the enemy of the people. They are not necessarily the enemy of the Zero-DTE trader, because this kind of volatility we welcome with open arms. I think that the world recognized that there was less to the story than there was, and even though the market moved dramatically on Friday, that move did not continue. And in fact, there's been a little bit of a rebound and it's been tempered. However, there are still outlets and some of them not part of the mainstream media, like Goldman Sachs and others, at least small factions of these outlets that are trying to still push a story that will instill fear in people. So you have these competing forces. Some people want the market to be tempered. Some want it to come down. Some just want the air of fear out there so that they can benefit from that. And then others want to keep on pushing it up. So it's not like there's a grand conspiracy where there's this malevolent force that's trying to squash the market or do something with the market. It's actually a conspiracy of many people trying to manipulate the market and push it in their direction. And quite frankly, this is not an unusual thing in the market. The idea that the market is being manipulated often is seen as a pejorative or something that is illegal. And in some cases it could be. But when people hear market manipulation, they think that, oh, it's these evil people of power that are trying to subvert the market and have it do their bidding at the expense of the little guy, which also is true, but it's not like a concerted effort by just one entity. It is anybody that has any level of power or influence trying to manipulate the market. And quite frankly, I would say that if you, and I'm pointing at you, if you had the ability, you would also be trying to manipulate the market. You would not be playing nice. You would do whatever you could to push the market in your direction, in your way, or set up the kind of condition that you want so that you could maximize your profits. And understanding that is something that is innate, that not only you, the person who may castigate those or vilify those that would manipulate the market, you would also manipulate it if you had the opportunity. And so when you look at it from that light, you realize that, yes, the market is manipulated, but it's not a bad thing. This is actually part of the discovery process. A number of competing and fighting foe, pushing, pulling, tugging, prodding, releasing conspiracy theories, doing whatever they can to push the market in their favor. But the fact is that there are so many of these at every strata, at every level, that it creates a market that actually works, that has some volatility. If we were all just sitting on our asses and giving a laissez-faire attitude to the market and just being passive, the market would never move. It would never move. And when it doesn't move, when there is no volatility, when there is nothing, no signal, it's just noise, the market dies. Nobody benefits. So I would say that things like the Moronic variant are actually quite beneficial to traders. Now, some traders, there's a level of volatility where they cannot handle. In fact, they cannot handle any kind of volatility because most traders are morons. And they're using things like technical analysis and other pseudoscience in order to try to predict market movement, which have virtually no edge. And they are the pawns of the market. They are the fodder for the people who have better tools, better understanding, and are able to manipulate the market. We need their money. We need them to contribute to our retirement funds. But from 0DTE's point of view, we need volatility too. Volatility is absolutely a necessity in our market. And it's like the Goldilocks and the Three Bears story. We need to be in the Goldilocks zone. What is the Goldilocks zone? If you remember, Goldilocks tried the porridge. One was too cold, one was too hot, and one was just right. Tried the bed. One was too soft, one was too hard, and one was just right. We need that Goldilocks zone in terms of volatility. We need enough volatility that we can find a signal and from that volatility, from the implied volatility, create enough premium that we can sell and use our strategies to enact an edge from there. But too much volatility and things get chaotic. Now the levels for us, if you were to equate that to the VIX, are between 17 and 34. That is what we would call the Goldilocks zone. Anything below 17 starts getting anemic and very difficult to distinguish between a signal and noise. When we start getting up into the 20s, mid-20s, upper 20s, things start really clicking. It is almost like you can't help but make money in that range. And for some people, that might seem completely outrageous, because on the S&P, when you're up in that range, you can have an expected move as much as 50 points. 50 points can be relatively significant. That in a market like this, that could be 1.25%, 1.5%, which is a significant move in the market. For most people, that is a very difficult market to trade. But as an option seller, where we can isolate price and then expose the volatility as premium, that is the ideal market. Once we start getting above that 34 level, things start getting chaotic again, and a little bit out of hand and a little bit chancy. But to tell you the truth, I would prefer it to be at the high end outside of the Goldilocks zone than at the low end below the Goldilocks zone. Below, there is nothing. There is death. It's anemic, low blood pressure, to the point where you're just not getting any signal. It is virtually impossible to trade that. Not impossible, but very close to impossible. At least when you're in the upper ends of the zone and you've spiked because of some story or problem in the market, a crash or whatever it is. They are short-lived, and they tend to spike and then retract. And that retraction is actually very beneficial to the option seller. We call that vega negative, theta positive. That is when premium has expanded or has become overpriced, and we're able to sell it at this overpriced level with almost a certainty that we're not going to maintain that level, or very rarely do you maintain it. You usually spike and then come down in a stair-step fashion. When it comes down, that's when the volatility starts contracting. And if you've sold it, that contraction is equated to the premium flowing into your account. So ideally, the best situation would be a market that is trending up normally, and then a quick but abrupt pullback that causes volatility to spike. Enter the trade there, purchase or sell premium at the bottom of that pullback, and then continue on its way in the previous trend. And when that happens, the volatility contracts. That is the ideal situation. But there are other situations that work just as well. Any kind of volatility or sustained volatility can sometimes work. And it really doesn't have to be super elevated. It's really relative volatility from where you start to where you go and where you end up. And I don't know if that makes sense, but that's generally what we're dealing with most of the time. Let's see, we have a question here. Lance says, I'm shocked that so many people don't realize this about volatility. John says, I noticed on some days that the market drops after there has been a pre-market pop. Is there any science to this, or just coincidence? Your thoughts? The market drops after a pre-market pop. Well, when you say a pre-market pop, you're living in the world of the U.S. market. You have to remember that the market is a continuous thing. That although there's the cash market during the Eastern time between 9:30 and 4 o'clock, there's actually a continuous worldwide market that's going all the time. And in fact, our S&P, that's what we have futures for, so that we can play that market all the way through. And that pre-market pop is nothing more than another market or another predominant market where something is happening there. Now, it is less consequence to us U.S. traders because the size of those markets, and namely that market that I'm talking about is the European market, is much smaller and has less impact. However, there are still many of the same international concerns that overlap the European market and the American market. And then the European market is still open when the American market is open until 11 o'clock in the morning. Is there some science? There is no science that's going to tell you that when you have a pre-market pop that somehow there is going to then be a drop right after the open. That there is nothing endemic. There is nothing statistical that will say that a pre-market pop will precede a post-market drop. In fact, sometimes it may continue. In fact, considering the fact that, as I said, the futures are open through that entire time. The same futures contract, the S&P, is open prior to the cash market open. And it's still representing all the same major concerns that are part of the U.S. market. They are international concerns, and they are affected across the globe. So just because we have that time frame at 9:30 when we transition into the U.S. market, all that really is just opening the floodgate for a number of traders that do not have the ability to trade prior to that time frame. So that really if there is a drop after that, there's nothing specific about those markets opening that would cause that drop or be statistical to the point where you could say that there's a sea change or anything. It's all continuous. It's just the players that you allow into the game at that time. Now, one could say that there are some that are bent to fade a move in the market. So if we open up the market, the cash market, and the previous close was lower, so we open up and we gap open, there are some people that have the idea or the notion that there is some statistical evidence behind fading a gap, or the idea that a gap must be filled. In other words, once we gap up, we must come back down and fill up that gap. Now, the gap is only in their world of a cash market that has a limited window. That gap doesn't exist in the futures market. It's a continuous thing. So for them, there might be some validity to that. It's the parable of the man in the cave that sees his shadow from a light from behind him, but he can never look behind him. So he only sees the shadow cast in front of him, and he has to discern what the world is like by looking at that shadow. It's the same way for people who are in the U.S. cash market. They do not see or understand the other markets that are overlapping or happen before or after, and they don't see that continuity. They see nothing but a gap, and to them, that gap has some kind of meaning. They don't know what it is. It's just the shadow from the light behind them. So vega negative, theta positive. What that means is that's describing the characteristic of the strategies that we put on. So vega is a measure. Think of vega and theta and delta and gamma as being controls or dashboard signals that will allow you to look at the nature of the behavior. Yeah. So think about these Greeks. They are nothing more than a peer into a way to describe how an options contract is behaving. And that's what they call the Greeks. Vega is a measure of volatility and how it affects the price of an options contract based on the change in volatility. And of course, theta is also a measure of the flow of that premium or the decay, the rate of decay. in that options contract based on the underlying price movement, right? So to say something is vega negative is saying that an options contract benefits when volatility is contracting. If it were vega positive, that means it would benefit or it would increase the value of that option if volatility was increasing. And then also for theta positive, that would mean that the underlying contract would benefit when theta was increasing. That's really what those terms mean. They are nothing more than dashboard signals that are looking at how an options contract is behaving, and delta being the change in price up and down, and gamma being the rate of change of price up and down. So all of these things are, like I said, nothing more than dashboard signals for us to look at and understand the nature of how one contract might behave versus another. So what we use are premium collection contracts or strategies, which is a collection of different options, calls, and puts, both long and short, that give us a certain characteristic. And that characteristic is designed to help us collect premium. We sell premium. We want to sell it when it's inflated or overpriced. And then as it contracts, then that is the income that we make. That is the result. That's how we realize our profit when it contracts. And so what we really want then is we want volatility to increase to inflate the premium. We sell it, and then we want volatility to decrease, vega negative. And the rate at which that premium decays is the theta. We want that to be positive. We want it to be that rate to increase. So both of those things happen when on a pullback after vega is high, and then price starts going up, volatility tends to drop, and theta tends to increase as we get closer and closer to the expiration of that contract. So theta is more time related. It's the time left for that option to expire. And then as we get closer and closer to that time, theta starts increasing. So that's why 0DTE is so important. We are at that very last day of expiration, where we make most of our money through theta as we approach that expiration, because the premium is decaying at an ever exponential rate, and we want vega to be negative. We want that premium that's there to decay even faster through the process of volatility decreasing. So that's what vega negative, theta positive actually means. So that's what we do. We are vega negative, theta positive wonks. We're waiting for the right situation where we can sell overpriced things and then buy them back when they're underpriced or after they've shrunk. And we use the fact that the last day of expiration will increase our probability of that very thing happening. And that is really the underlying basis behind the 0DTE trade. So 0DTE meaning 0 days to expiration, the last day of expiration, when all of these things, this condition, vega negative, theta positive, happens, and happens at an ever increasing rate the closer you get to that expiration. Now our job is to make sure that price and our strategy are aligned with this event, this vega negative, theta positive event. And we do that by simply analyzing the market, where we think price is going to go, and how it may behave as it's going there by looking at the market structure, and then placing and modeling that idea with a premium collection strategy using options over that market structure, giving us the best opportunity for price to be in that area when or as the contract expires and goes into the very waning moments of its life at the end of expiration, 3 times a week, Monday, Wednesday, and Friday. So it's a really powerful strategy. A lot of things are in our favor, including this time constant Time is constant. Time is going to come to an end relative to, or in the viewpoint of a options contract, at the end of the market time at 4 p.m. every Monday, Wednesday, and Friday. This week, by the way, we have an extra 0DTE day that is brought over from last week because we had the holiday Thursday and Friday. Shortened day on no trading on Thursday and shortened day on Friday. So where we would normally have the 0DTE on Friday, and sometimes when we have a holiday on Friday, we move it to Thursday. But in this case, we couldn't because it's Thanksgiving, and Thanksgiving is always on Thursday. So what they do is they take that 0DTE and they push it to the next week on Tuesday. So this week is one of the only weeks. This may also happen during Christmas sometimes too. Is one of the only weeks where we have actually 4 0DTE events. We have one today, Tuesday, Wednesday, and then Friday. So it's a very special week for us. One of the problems, though, with having 4 0DTE events, you may think, well, Ernie, how could that possibly be a problem? You have 4 chances to make money instead of 3, or 2 like last week. And the answer is that overtrading. The beauty of the 0DTE trade and having it only on Monday, Wednesday, and Friday is that it provides a natural cadence where we can get all amped up and concentrated on that one day where we have that 0DTE event, and then we have a day of rest where we can recharge, and it's meditative, get back into the right frame of mind so that we can look at the next day with fresh eyes. When we have consecutive days like this, it doesn't allow us to do that. And I would expect that in the long run, if we had many of these consecutive days, that our performance would not be as good. And in fact, I think that this is one of the principal failings of people who day trade that want to trade every day. When they trade every day without having a natural cadence to their trading, without the ability to reflect or retrospect what they are doing, if they get into a tilt situation or a bad situation or bad choices, they tend to spill over to the next day and then amplify, and then they get into a constant spiraling down spiral into hell. And so having that natural cadence, I think, is one of the real benefits of 0DTE. Now this week it's going to be a little different. But because we're, I think, already well attuned to that, and it's only one time out of many, and we had an extra long break last week, I think that we should handle it with no problem. It's not like day traders that are doing this every single week. And quite frankly, day traders, besides the fact that they don't have that natural cadence, and also because they are using technology or analytical methods that really have no relevance and no statistical edge, they're at a great disadvantage. And it's probably one of the reasons why day traders that are using TA and Fibonacci and price action generally are failures. 95% of them are failures. This natural cadence that we have, this effort and then rest, effort then rest, effort then rest, is far superior, besides the fact that we're working with actual edges, known edges, like the overstatement of volatility, which is a known thing and a measurable thing. So anyways, that is what we do. So we had another great 0DTE day today. It was probably somewhere between a 200 and 400% day, depending on when you got in, when you got out, how you managed your profits. Some people may have done better, some may have done worse. All in all, it was a good 0DTE day, very low stress, very typical of 0DTE. Low stress, easy going, a small risk, very large profit potential. And now the market is pulling back. We're good with that. We have a longer term trade where that pullback will actually benefit as well. So there you go. Another 0DTE day in the bag. Now, if you'd like to try out the 0-DTE service, go to 0-DTE.com/try. That's TRY. And you'll get a 4-week trial. After that 4-week trial, if you decide to come on, we will rebate the entire cost of that trial. Now you may be asking, why do you charge for your trial? Because during that trial, the price, first of all, for the trial is insignificant compared to what you're going to learn and potentially what you're going to make, which often is enough to pay for multiple years of the service. But you're going to get an intensive education in that 4 weeks. And then once you've decided that you want to continue on, which most people do, I will rebate the cost of that trial. So the worst that's going to happen when you take our trial is that you're going to get a fantastic education and infused with a strategy that you'll be able to use for the rest of your life. Now, like everything else, the reason why you would become a member is because you're going to have only half the truth, right? You're going to be half practiced. And it's like learning chess. You can learn all of the moves and maybe some of the basic opens and that sort of thing. Nothing of the expanded open or position or the middle or the end game. And then that's why you choose to hang out with us. And that's the real benefit. All right. That's all I've got to say. I want to thank you, everybody, for showing up here. Thank you for the questions. I really appreciate it. And there will be another Zero DTE podcast tomorrow and Wednesday. Normally it's Monday, Wednesday, and Friday, but I vowed to do a podcast after every Zero DTE day. And as to the coronavirus variant, the Moronic variant, bring it on. Peace to everybody. All right. We need the off button. There it is. End stream.